All right, so let's continue our discussion of the statement of cash flows and look at a little bit on investing activities. We've covered most of this already, so this should be somewhat a review. But when we talk about cash flow from investing activities, we're talking about several things. We could be talking about the purchase or sale of long-term assets, otherwise known as capital expenditures. So we could be talking about buying that delivery van, or after using it for its intended purpose, selling that delivery van. We could be talking about mergers and acquisitions. Specifically, we might decide to buy another company. We might decide to sell a division of our own company. Okay. The first would be an outflow. The second would be an inflow. And then finally, we talked about this before. Sometimes companies have excess cash. They will invest that excess cash in some type of marketable security. When we initially make that investment, the purchase is an outflow from investing activities. When we ultimately make the sale of those securities, when we need that excess cash for our operations, that sale would be an outflow from investing activities. We've kind of covered this again, but you have an additional slide here for cash flows from financing activities. So you can go ahead and look through these again. Again, we know we've already covered this. So this is just a review slide more than anything, as was the previous one. So I want to get back to the statement of cash flows in general. What we have here is a little example for this company, Rundle. And we don't have any figures here, but it kind of shows you the order. We had something similar to this a few slides back. This is a more formal illustration, no numbers here, but you can see the order. We start with operating, then investing, and then financing. That gives us our change in cash. We add that, whether this change in cash is positive or negative, we add that to the beginning cash for the period, and that should better equal cash at the end of the period. Here we have an example of an income statement. We said at the beginning, or towards the beginning of the presentation, that we were going to start all of our reconciliations with net income, because we're about to get into some adjustments here. So we see up here sales are well over $1 million. We have gross profit almost 400,000, and we have income from operations 187,000. Well, the fact that we've got net income of 108,000, we're going to have some adjustments to the cash account, no doubt, but we're going to start off with net income. That's always going to be our starting point using the indirect method to reconciling, not reconciling cash, but where the cash came from for the period. We have a balance sheet here. What does that tell us? Well, this is a comparative balance sheet. So if our income statement was from the year 2018, and you see here that the December 31st cash balance for 2018 is 97.5, but last year it was 26,000. That represents a change of 71,500. Well, how did that happen? Okay, that's what we're going to get to the bottom of with the statement of cash flows. We know that cash went up by 71.5, but we don't know how just yet. Now, we've got some clues right here, but we're not going to get into a detailed discussion of all of these items. We're going to look at some basic items and kind of focus on the pluses and minuses, again, using that net income as our starting point. Okay, so continuing our discussion of cash flows from operations, we're going to start making some of those adjustments that we discussed. Now, we've had some examples of this already, but the more we look at this, hopefully the more sense it will make to you in your mind. It says here accounts receivable from sales to customers amounted to $40,000 and $32,000 at the beginning and end of the year, respectively. So it was $40,000. We'll just say it's a calendar year. It was $40,000 on January the 1st, and it's $32,000 at December the 31st. Income reported on the income statement, this is net income, was $110,000. That's our starting point. It says, exclusive of the effect of other adjustments, the net cash flows from operating activities to be reported on the statement of cash flows using the indirect method is, well, what do you think it is? Let's see, I'm losing my spot here. I'm going to go ahead and tell you, right now we are at 118,000, not 102,000, 118,000. We started off with 110,000. Receivables went down. So that means that overall, considering all of our cash received, that there's about $8,000 in cash that is not reflected in net income because we did a really good job of collecting cash from sales made on credit from the prior period, prior year. It says accounts payable to vendors amounted to $25,000 and $23,000 at the beginning of the year and end of the year, respectively. So we kind of have the opposite thing going on here. Let's just see here. Let's clear this out, make that a little smaller. Our starting point is 110,000. Okay. And we owed 25,000. Now we owe 23,000. So we owe $2,000 less. Well, how did that happen? Well, let's take the amount that we currently owe first, and we're going to subtract from that the beginning amount, and that gives us 108,000. So payables went down. That means that we essentially used $2,000 in cash to pay down payables from a prior period. Prior period will not be included in current net income. Therefore, exclusive of other impacts, other adjustments rather, we're going to have a balance right now of $108,000 in cash flows from operations. Okay, now we actually know that we also had an $8,000 addition, but I just want to focus in on this one transaction. Depreciation for the year totals $14,000. Income reported on the income statement was $110,000, exclusive of other adjustments. What happens? Well, this $14,000 in depreciation was a deduction to net income, but it's also a non-cash expense. So exclusive of anything else, we would have $124,000 in cash. Point being, depreciation is a positive addition to net income in the reconciling of cash process. What else do we have? Cash flows from operations, adjustments to net income, gains. Okay, very good. A company sold a piece of equipment with an original cost of $25,000 and a net asset value of 0 for $3,000. Okay, so what we're talking about here is we paid $25,000, but we fully depreciated the item. That doesn't mean that I don't like this terminology here, net asset value. I would rather this say net book value of $0. We sold it for $3,000. We have a $3,000 gain there, but selling equipment is not part of the ordinary and necessary course of business unless we're in the equipment selling business. So we're going to take our $110,000 and we're actually going to subtract $3,000. And so, exclusive of anything else, our cash balance for the year, or our cash flows from operations, are at $107,000. If this net book value had been $3,000, or let's just say it was $6,000, and then we sold it for $3,000, well, that would be a loss of $3,000, and we would actually add that to net income rather than subtract it. Okay, but we have here a gain. Losses, okay, pretty much the exact same example that I gave just now, except that we're using $5,000 instead of $6,000. So we have a $2,000 loss here. Again, this really needs to say net book value, not net asset value. Net book value of $5,000, we sell it for $3,000, we have a $2,000 loss. Well, that pushed our net income down $2,000, but that was an investing activity, so we're going to add that back. So exclusive of anything else, we're at $112,000. So let's look at all of these together. Income reported on the income statement for the year was $110,000. Accounts receivable decreased, so we're going to add $8,000 because overall we had $8,000 in collections that didn't have anything to do with this year's net income. We have a decrease in accounts payable of $2,000. That means that overall we actually used some cash to pay down liabilities from a prior period, and that has nothing to do with this year's net income. So decrease in accounts payable is a subtraction. Depreciation, non-cash expense, so we're going to add that $14,000 back to cash flows from operations. We had a gain of $3,000, which is subtracted, and we had a loss of $2,000, which is an addition. So here we have all of these numbers added up together, and we show that even though net income started off at $110,000, our actual cash flow from operating activities is $129,000. All right? Make sure that you go over these slides as many times as you need to get this concept down. And then here what we have, let's see here, what is this? Let's see, okay, we have another nice little example here of, and this actually does use some numbers, using the indirect method for operating activities, cash flows from operating activities. Again, we start off with net income. In this case, it's $108,000. We have a positive adjustment for depreciation of $7,000, and we had a gain on the sale of land. Well, land is an investing activity, so therefore we're going to back that $12,000 out. Okay, that 12, if we hadn't made this transaction right here, if we had not made this transaction right here, our net income would be $96,000. So the gain on the sale of the land needs to be backed out. If it was a loss, we would need to add it on. Okay, but it's a gain here. What else do we have? increase in accounts receivable. Okay, that's a subtraction. That means that $9,000 of this net income hasn't been collected in cash. Decrease in inventories is going to be a positive addition, because what that's essentially saying is that $8,000 of the inventory that we sold that ultimately helped us get to this net income of $108,000 was purchased in a prior period. Decrease in accounts payable, that means that we're paying down old debt. That means $3,200 of what we paid out in cash is related to debt from a prior period. Now we have the exact opposite. Accrued expenses have gone up. That means we owe for items that have impacted net income, but we haven't paid for it yet. And then decrease in income taxes payable. Payables are a little bit easy, because if it's a decrease, it's a subtraction, and if it's an increase, it's an addition. So in this particular case, we have net cash flow from operating activities, $100,500. It actually went down largely because of this item right here. All right, let's go ahead and stop this video. It's starting to get a little bit long, and we'll pick up with a discussion on investing and financing next.